In this video, we're going to talk about how you can retire early from real estate investing. And by the end of this video, you should probably realize that you don't need as much as you think to maintain your existing lifestyle. So none of us are getting any younger. We all eventually want to retire. We all want to travel, spend more time with friends and family. And when that time comes, you want to have a stream of income that's coming in. Traditionally, this income comes from three sources. One of them is Social Security. So this is the thing that you've been paying for all your life, and then that comes from the government. And I think that I know there's a lot of issues surrounding that, whether it's going to be funded or not, etc. I'm going to assume that this is going to continue to be funded, but the income that's coming from that is not as much as you expect. You can actually go on the Social Security website to figure out how much that is. Second is pension plan. So when I'm talking about pension plan, I'm talking about corporate or government or state pension plan that are paid to employees. And these are basically defined benefit pension plans. So I'm not including in there 401ks because these are really part of savings. These pension plans, normally they come as a percentage of final salary multiplied by the number of years of service. So they're called defined benefit pension plan typically. So these have been under tremendous stress over the last 30 years. We have a significant reduction in the number of unions in North America, and these plans have been seriously under attack. Many corporations have gotten rid of their defined benefit pension plan, replaced them with 401k. And that basically is shifting the risk of retirement from the employer to the employee. Now, the employee just saves money with the 401k, and then eventually they're going to have to figure out a way to get a pension out of that. And this brings me to the third source of income at retirement, which is 401k. 401k, IRA, savings, investments. So this is basically how much you have saved at that time. And the key here is how are you going to convert these savings into a stream of income. And this is very, very important. Now, if you don't have a pension plan, which is like most people, the only people right now that have pension plans probably work for the government and large corporations or are unionized. So these are probably the only people. If you don't fit in these categories, that means that your savings are going to have to be a little bit more a little bit bigger in order to compensate for that loss of income. Now, for years, financial experts, advertisings have told us that in order to retire properly and adequately, you need to have $1 million up to $3 million in savings in order to have a sufficient income at retirement. We also hear some other metrics, like it should be like 10 times your salary that you should have saved up in order to retire. You can also look at retirement calculators online from AARP, for example, where they basically bring in your Social Security amount that you should get if you have any pension plan, how much money you can expect to receive at retirement, and how much money you need to save in order to maintain your lifestyle. This goal of $1 to $2 or $3 million or 10 times your earnings is not very practical. And this is what I call a cash saving goal, because it's missing out a key component, which is how will these savings be converted to a stream of income. And at retirement, the environment that you are, the economic environment will really dictate how much income you can receive from these savings. So these savings in a normal, regular interest level, normal economic environment, there are typically 4 different ways of converting these savings into a stream of income. The first one is a bond ladder. This is basically a portfolio of bonds that have different maturity date, and basically as they expire, they basically generate income. Unfortunately, in a low interest environment like the environment that we're in right now, we have very low interest rate. This is not feasible. The second method is the asset withdrawal method. Sometimes it's called the 4% rule. And the idea there is that you would invest your savings in the stock market, hopefully something that is fairly stable. And then every year you would extract 4% of whatever amount of money you have in your assets to basically pay for your expenses. The idea here is that on average the stock market basically rises about 8-9%. So if you take out 4% every year, then you should have enough money to retire for a long period of time. Recently, this model has been updated to about 5.3%, but these are all pretty safe assumptions. The issue that I have with there is that this payout amount is only 5%. It's not very much, and what happens is that you need to save a lot of money in order to reach that 5% goal, so that you can compensate for the income that you need. So if you think 5%, for example, if I make $100,000, that means I have to make 20 times that I have in savings in order to get that 5%. So that's $2 million. The next option is the annuity. So I'm not a big fan of annuity. First of all, in low-level environment, the payout is not very high, and it's typically, on a 2% spread in interest rate. You can reduce your payout amount by as much as 20%. So that's pretty significant. The other reason why I don't like annuity, there are so many reasons, but one of them is that really that payout amount in general is not that high. So you would put $1 million in the annuity, you would pay your premium. So this is the money that you would give to the life insurance company, for example. And then they would typically, once you have all the waiver for inflation adjustment, you want to have survivorship for your wife or your husband, and you have all these things in place. Once you have all these waivers, often the payout amount is between 3 and 5% of the amount that you have. So on $1 million, you would get between $30,000 and $50,000 a year, and you put $1 million in the bank. That's one issue. The other issue is that if you don't buy there's a waiver to make sure that you have that you at least get the amount of premium back. If you didn't pay for that premium, which obviously reduced your payout amount. If you don't have that, if you die a couple of months after you start your annuity payout period, that money is gone. The $1 million that you paid in premium is gone, and it's helping pay the payout for somebody else. So nothing is left for your children and your legacy. All that money is gone. If you live a very long life, then that works out great. But there's always a chance that you die a little bit early. Typically, you're not in control. And finally, one of my favorite is rental portfolios, which basically is not discussed out there. And that's because a lot of the financial planners are not getting a commission on suggesting that people invest in rental portfolio. They get paid a commission on assets under management and number of transactions being completed. So at retirement, converting your assets into a stream of income is relatively easy. But really my suggestion is that you start working on building that rental portfolio early. Start building that single family rental portfolio, eventually move maybe into apartment buildings and multifamily. The reason for this is that there are significant tax advantages of investing in real estate. So you want to take advantage of those as early as possible to offset, to help you save taxes on your wages, your earned income. The other advantage of the rental portfolio is that it is indexed almost automatically with inflation because the rents are increasing every year. Typically the mortgage, if you have a mortgage on it, it's going to stay pretty stable. The expenses are also staying relatively, they actually increase a little bit with the rent, but typically not as much. And then you have the property taxes, which are also not growing as much as the other expenses. So when you take that into account, typically the cash flow increases a little bit over time, or at least at the very least stay stable. The other advantage of this rental portfolio is obviously appreciation, especially if you started building your portfolio earlier, then you have equity that's built up into the property. This gives you, even at retirement, the opportunity to refinance these properties, maintain their cash flow positive situation, and then invest in other properties to increase your cash flow per year. So this is a great strategy. The equity is also beneficial for the legacy for your children. So real estate is a great way to pass on wealth to your children. So as you build equity, this equity is then transferred onto your children. So how do we get to estimate how much you need in order to retire and when you should start investing? So instead of this cash saving model where I'm going to tell you you need X dollars of money saved up so that you can do a transaction at retirement and then buy a big apartment building, instead of doing that, we're going to work into a monthly passive income. We're going to figure out how much passive income you need, and then you're going to start building your turnkey rental portfolio until you have reached that passive income level. This is a much better way for you to track how well you are doing toward your goal. All right, let's start calculating that passive income target, that monthly passive income target. We're going to start with our regular expenses. How much are we spending today? A lot of the retirement calculators out there online are suggesting that you would spend 80% less at retirement, and therefore you need 80% less in income. I plan to live just as well after retirement than before. I think I'm going to travel probably more, and I'm going to do different things. And have more hobbies, and so I think I'm going to spend some money, and I don't want to live less at retirement. So we're going to start with our regular expenses, and then from that we're going to add a cushion of 5 to 10%, just to make sure that we have enough funds in case something happens, some emergency happens. So for example, for me, I say, okay, my current monthly expenses, these are a fictitious number, but let's say my current expenses are $9,000. I'm going to add 10% on top of that, so I'm going to add $1,000. So now my passive income is $1,000. So this is $10,000 is what my target is. But I'm expecting some money from the Social Security, like I mentioned. So you can look on the website, socialsecurity.org, and find out how much security you can expect at retirement. And you can subtract it from your 10,000 target. The next thing is that if you are getting a pension plan, then you can also subtract that amount. So for me, at $10,000, I'm expecting from Social Security about, let's say, $2,000 a month, and then I'm expecting $0 from employer pension plan. So that means that I have my target monthly passive income is $8,000. So now what I need to come up with is a plan for investing in real estate, in rental properties that are cash flowing, so that eventually at retirement or near retirement, or whenever I want to retire, it could be early retirement, I have $8,000 in passive income coming in. So how many rental properties do I need? Many of the investors that are investing with me and with us, the typical price for these properties is $90,000. They put $20,000 down, and then their net cash flow after they paid all the expenses, property management, insurance, property taxes, and the mortgage, they're left with about $250 a month in net cash flow. So that's $20,000 down payment. The rest is mortgage for a property that's worth $90,000, let's say. So how many properties do I need at $250 in net cash flow per month? Well, I need about 30 properties. So yes, you can wait till retirement to get that, but you can also get started early. You can get a 32-unit apartment building or 36-unit apartment building at retirement with your savings. It's quite feasible with, with let's say $20,000, so about $600,000 in cash. You can, or $500,000, you can get an apartment building of that size that's going to cash flow at $8,000. That shouldn't be a problem. So that's the advantage here. If you want to start building earlier, then you can really track your progress. So let's say you buy one property in 1 year, then that means that you can see that you have now $250 a month coming in from your rental property. Next year you buy 1 or 2 or 3, then you end up at $1,000 in passive income. And you can see that, after only a few years, you're already at 1/8 of your target, or 1/4 of your target. And you can kind of gauge where you need to be and how close you are to retiring. So when I compare this kind of goal, which is like with a passive income, a monthly passive income target, it's a lot easier to track your progress and figure out a tangible way and practical way of how you're going to have a stream of income at retirement. Instead of the $1 million, $2 million, $3 million in saving in 401ks that you need to have. This is very hard to track. This is, so I much prefer the monthly passive income target as a method for tracking your progress and also motivating you to achieve financial freedom. Well, thank you for watching my video. I hope you learned something today, and that's going to help you bring you closer to financial freedom. Make sure you watch the other videos in my channel, and don't forget to subscribe.